He went from 20K to 70 million using a strategy anyone can learn. From my first million with Sean Puri and Chris Camillo. 80 minutes. An extraordinary conversation with a self-taught investor who has compounded at roughly 75% annually for 18 years using what he calls social arbitrage investing, a methodology that ignores traditional financial analysis entirely and instead trades on observations about how the real world is changing. Section 1. Meet the guy who breaks every rule of investing. The episode opens with Sean Puri framing exactly how unconventional Chris Camillo is. You break all the rules of investing, Sean says. Everything I normally hear is you should just index, do not try to beat the market, do not take any leverage, but you do the exact opposite. You will try to beat the market. You trade with leverage. You are moving in and out of positions. You are not a buy and hold forever kind of guy. Chris confirms the numbers. Starting with $20,000 in 2007, he has generated approximately $70 to $80 million in returns over 17 to 18 years. He has been audited and will be re-audited at the end of this year. His annualized total portfolio returns are around 75%. He has had his results tracked on platforms like Covester, where he was at one point ranked the #1 investor out of 40,000 accounts. This led to appearances on Fox Business and a book deal for Laughing at Wall Street. Section 2. The methodology, observational investing explained. Chris describes his approach as fundamentally simple. You are looking for any change happening in the world, whether it is a change in consumer behavior, culture, technology, weather, or politics, anything that has the potential to be meaningfully impactful to one or more publicly traded companies. If you can surface that change early and connect the dots back to a company that would benefit or be harmed, that is the entire methodology. It does not incorporate fundamental analysis. It definitely does not use technical analysis. In its purest form, you do not even need to know what the stock is trading at when you open a position. You would be completely blind to everything other than the extent to which other investors are aware of the information you have found. You enter at the point of information asymmetry, when you know something and very few others do, and you exit at the point of information parity, when other investors start to learn about the same thing. But there are nuances. You have to assess whether the information is actually meaningful. Is it a needle mover? Is it really off radar, or are institutional investors already accounting for it? Are there other factors happening simultaneously that are equal to or more important than the piece of information you are trading? Section 3. The origin story, Snapple garage sales and a kid on the bus. Chris was entrepreneurial from a young age. Before he could drive, he would take 3 or 4 buses before school to estate sales, looking for mispriced merchandise. His thesis was brilliant in its simplicity. Most estate sales were run by older women who knew the price of silver and jewelry very well but were terrible at identifying value in male-oriented items like old trains, watches, and collectibles. This was pre-eBay, so there was no way to quickly look up market prices. One morning at 7-Eleven, Chris noticed that the door space dedicated to Snapple had been cut to make room for Arizona iced tea and other competitors. The clerk confirmed this was the new normal. Chris talked to his older brother, a stockbroker, and asked if he could make money from this observation. His brother taught him to short Snapple using put options. Chris invested $300, most of his money from garage sales. A few weeks later, Snapple reported bad earnings for the first time due to retailers giving them less shelf space. His money tripled. The lesson was profound. Wall Street professionals could have easily noticed the same thing at their local 7-Eleven, but they were distracted by macroeconomics, noise, herd mentality. A teenager saw something simple that was right in front of their faces. Section 4. Finding Wall Street's blind spots. Sean draws a parallel to the garage sale strategy. Just as Chris identified that estate sale operators had blind spots in male-oriented collectibles, he applied the same principle to Wall Street. Most people who work in finance are guys, white guys who live in New York of a certain age. Where are their blind spots? Chris confirms this is exactly how he identifies the highest probability opportunities. The vast majority of his big wins were around changes in consumer behavior and culture that were primarily female-oriented, youth-oriented, or connected to demographics that were not older, white, northeastern, geographically located investors. One of his favorite examples is ELF Cosmetics. Beauty influencer Jeffree Star made a single YouTube video about a drugstore product, the ELF Primer Putty, saying it was just as good as a $60 product. The video got 10 million views. Chris went to a Walgreens and watched moms coming in with their kids buying out all the ELF products. He then called a Wall Street analyst covering ELF and asked what they thought about the Jeffree Star video. The analyst responded, "Who is Jeffree Star?" At that moment, Chris knew everything he needed to know about the trade. ELF was trading at $7 a share at the time. It eventually reached $170. Section 5. Ticker Tags, Institutionalizing the Method. Chris and his business partner created a platform called Ticker Tags in the mid-2010s with access to the Twitter decahos, a 10% randomized sample of every tweet in real time. They hand-curated approximately 1.5 million word combinations, representing how people spoke about every product, brand, and anything connected to publicly traded companies. For example, for a company like New Brands, which owns Elmer's Glue, tags would include not just the product name but also DIY slime, because the slime trend among kids drove enormous Elmer's Glue sales. The system monitored mention frequency in real time, benchmarked against historical norms including seasonality and flagged anomalies. They sold this platform to hedge funds and sell-side banks. But here is the fascinating twist. Wall Street could not figure out how to use it. Chris spent years flying to New York weekly, training top banks and 5 or 6 of the top 10 hedge funds. They had interest in the results but could not build teams around it. Hedge funds have mathematicians building quant algorithms and traditional fundamental analysts crunching numbers. They did not have 20-something-year-old women on staff who were savvy at interpreting conversational data. This is still a data set that Wall Street is scared of, Chris says. This is still a methodology they have a hard time with because they cannot document the degree to which it is meaningful for a thesis. And that is unfortunate for Wall Street, but fortunate for retail investors. Section 6. Greatest Hits, Roofing, Palantir, and the Sphere. Chris walks through several of his most successful trades. The roofing trade is elegant. Every spring, he would track Google Trends data for the phrases roof damage and roof repair. When there is a hailstorm, people immediately search for roof repair. Beacon Roofing, one of the largest roofing companies in North America, would benefit from damaging hail seasons. Wall Street relied on insurance sector reports that were delayed 5 to 6 weeks. Google Trends gave Chris real-time data. One season, search peaks were nearly triple anything he had seen in years. He took a very large, heavily leveraged call position on Beacon Roofing. It was a greatest hit. The Palantir trade was one of his most controversial. He went all in, unbelievably leveraged, at $30 a share. Longtime Palantir investors called him an idiot, pointing out they had been in since $6. Chris's response was characteristically confident. "I'm not trading the information you were trading at $6. His thesis was that people did not understand where Palantir would sit in the AI wave. The company was just starting to show results from a new product with clients. Over a 12-month window, everything Palantir had been working on for years would come into view. He did not care about the valuation. Palantir went from 30 to over 160. The Sphere trade came from reading TikTok comments about the Wizard of Oz show in Las Vegas. In the first 48 hours after the show opened, Chris read thousands of comments from people planning to fly in from Europe to see it. He took a monstrously large leveraged position. As other retail investors started noticing seats selling out, then Wall Street picked up on it when the company added new shows. The stock more than doubled, almost exclusively because of Wizard of Oz. Section 7. The Biggest Loss, Tim Hortons and the Lesson of Incomplete Research. Just before the pandemic, Chris made the worst trade of his life. He was massively leveraged in QSR, the parent company of Burger King, Popeyes, and Tim Hortons. His thesis was strong for 2 of 3 brands. Burger King had the Impossible Whopper driving record sales. Popeyes had the crispy chicken sandwich from the Chicken Wars that was selling out in 2 hours every day. The third piece, Tim Hortons, was the largest part of the company. Chris assumed it would be fine, maybe flat. He just could not extract much information about a Canadian coffee chain through his usual methods. It turned out Tim Hortons had an annual franchisee meeting in Orlando just weeks before earnings. There was essentially a revolt by franchise owners over terrible corporate decisions that were crushing sales. Chris did not know about the meeting. If he had gone, he would have hung out at the bar and talked to franchise owners. He would have known. Tim Hortons had one of its worst quarters ever, completely destroying his levered bet. He lost a full third of his portfolio. The lesson he took away was painful but clear. If you are going to take a leveraged bet on a thesis, you cannot be lazy. You have to be comprehensive in your research. Section 8. The COVID trade, from catastrophic loss to the trade of a lifetime. What makes Chris remarkable is what happened next. Just months after losing a third of his portfolio, he was tracking the virus coming out of China, using Google Translate on medical reports to assess how serious it would be. It became very clear this was going to be a global pandemic. He started putting 10% of his portfolio into puts on the S&P, casino stocks, and airlines every week. For 3 to 4 weeks, the market did not move. He lost 30 to 40% of his already diminished portfolio. Then one week the market cracked, down 2%. The next week it really hit. That was one of the biggest trades of his life. Then 2 days after the market bottomed, he identified 14 to 15 companies that should never have gone down in the first place. Companies that should have benefited from everyone being stuck at home. Hewlett-Packard for home printers, Peloton for home workouts, Shopify for online shopping, Amazon, Campers World, Boat Stocks, a Canadian company that owned Schwinn bicycles, which went up 8 to 9x over 9 months. He took all his gains from shorting and put them into leveraged positions in these 15 companies. That year he made approximately $30 million. It was, as he puts it, a wild ride. Section 9. Current positions, Bloom Energy and the AI energy trade. Chris's current favorite AI play is Bloom Energy, a company with a fundamentally different approach to powering data centers. Instead of gas turbines, they use a chemical process to generate power. The key advantage is speed. A data center can get energy through Bloom and be operational 6 to 12 months faster than waiting for gas turbine approvals. The stock is up 5 to 6 times over 8 or 9 months as people start to recognize this. But controversy remains. They only have a couple of big hyperscaler deals, including one with Oracle. Chris also notes the noise in the market right now, with narratives about space-based data centers potentially undermining terrestrial energy companies. He dismisses this as typical market ADD that changes week to week based on whatever the hype story is. Section 10. The philosophy, bucketed risk, and the mission to close the wealth gap. In the final section, Sean pushes back on the idea that anyone can replicate these results. He argues that Chris has a very unique skill set and that people should be cautious about trying leveraged observational investing. Chris partially agrees but reframes the conversation. His overriding purpose, he says, is to inspire every human on Earth to enter the investing class. He believes it is the only way to solve the wealth gap. The income gap is exceptionally difficult to solve, but the wealth gap is solvable by getting more people to invest. The practical advice he gives is about bucketing money. Everyone should have a big money account funded through small daily trade-offs, making your own coffee, clipping coupons. Each saved dollar is not $5 saved. It is potentially $100 if invested aggressively over time. He is emphatic that this should be done with risk capital only, not retirement money or kids' college funds. He also graduated in the bottom 25% of his high school class. With today's college admissions, he would not have gotten into any U.S. university. Sean offers honest perspective. If Chris were selling a course, he would not have run the episode. The idea of scrolling TikTok comments and making leveraged bets is heretical to conventional wisdom. But Chris is not selling anything. His YouTube channel Dumb Money Live shares ideas but never specific trades. He encourages people to steal his ideas, poke holes in them, do their own research, and make their own risk-adjusted decisions. The conversation ends with Chris mentioning his upcoming venture in the private jet industry, which he sees as a beneficiary of the coming age of abundance. He draws a parallel to the pandemic, when people had excess time and money and dug into their hobbies and interests. As automation and AI gradually free up human time, travel and luxury experiences will only grow. He is ultra-long on private jets, though he personally carries too much guilt to fly private. Key takeaways. Chris Camillo turned $20,000 into approximately $70 to $80 million in gains over 18 years using observational investing, which ignores fundamentals and technicals entirely. The methodology is simple. Find meaningful change in the world before Wall Street notices. Enter at information asymmetry. Exit at information parity. His edge comes from monitoring spaces Wall Street ignores, particularly female-oriented, youth-oriented, and culturally driven consumer behavior. He spent 4 hours per night reading TikTok comments for investment ideas. The ELF Cosmetics trade from $7 to $170 per share began with a single influencer video. His biggest loss, a third of his portfolio on Tim Hortons, taught him that leveraged bets require exhaustive research with no shortcuts. His biggest win, approximately $30 million in 1 year, came from shorting the pandemic early, then going massively long on stay-at-home stocks at the bottom. Wall Street struggled to adopt his conversational data methodology because their teams lacked the cultural fluency to interpret social media signals. He does not sell courses or publish trades. His mission is to inspire more people to enter the investing class as a way to close the wealth gap. Current favorite play is Bloom Energy for AI data center power infrastructure.